Hello, everybody. Hello, 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 hello. Welcome. It is Tuesday. Remember, no market lines tomorrow or the rest of the week. How is everybody doing today? Can everybody hear me okay? Yes. All right. Excellent, 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 excellent. Steve, the Wiz, Pops, yeah. Jeremy, Trading Dan. Awesome, 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 awesome. All right. Well, here we go. We're going to continue on from where we were yesterday. Let me just pop something in over here, guys. All right. Looks like in OpVol, a few more people getting filled right here at 165 in KTOS. But today we are going to continue what we started yesterday, talking about synthetics. What is a synthetic? Well, we know anything. What's up? We got lots of people in here today. Love it, love it, love it. What is a synthetic? Well, a synthetic anything is a replica, right? It's not the real thing, but it kind of acts like the real thing, like synthetic turf or whatever it might be. But in regards to options, there are synthetic options. We touched on this yesterday. Now we're talking. There are ways to replicate a put position using calls, a call position using puts, whatever it might be. And sometimes it can work to our advantage, sometimes not. But this all happens because of the relationship of puts and calls, because of something that we have discussed many times called put call parity. Okay, so what are synthetics? Well, in the world of options, it's a way to artificially create a financial position with a different strategy. But the dynamics and the characteristics of that position are the exact same as the position that you wanted to get to. These are possible again because of put call parity. Everybody remember what that is? Put call parity? Basically, what that says is when you look at a call and a put, same strike, same expiration, okay, they have to have the same amount of premium, the same amount of extrinsic value built in. Otherwise, there would be a very big, major arbitrage between the two. So take a look at this. Three positions: stock, put, call. Okay, stock, put, call. You can buy 100 shares of stock, okay, or you can buy one call and sell one put of whatever strike, whatever expiration you want, and that will replicate that position. Okay. Now, a little bit of algebra, I guess. If we use this equation up here, okay, where a synthetic long stock position is the same as owning a call and selling a put, algebraically, we can get to, okay, how do we get to a long call synthetically? How do we get to a long put synthetically? So a long call position is the equivalent of being both long the stock, owning the stock, and long or owning the put. Kevin, it's well, you're not going to equal 100 that way if you use different strikes. That's why to have a true synthetic, you have to have the same strikes. Because if I take different strikes, whether further in the money, out of the money, whatever it might be, then those deltas, the combination of a call and a put, are not going to equal 100. Okay, and then also I can get a long put by owning a call and being short the stock. Now, this may seem weird. Why are we discussing this? Doesn't make sense. Let's go through some numbers on this, though. Okay, and here are the components of synthetic strategies. Kind of just what I just went through, but more in chart form now. Okay, but all this comes down to the same algebraic equation. Nope, not different expiration dates, Bill. Let me go back here and say it again here. Okay, and we'll look at some examples. We'll look at some live examples. Okay. Same expiration, same strike. Okay, so these are the components of coming up with the different types of synthetic positions. Now, if you had a long stock position, if you just owned 100 shares of your favorite stock, you would have a P&L that just looked like that, right? For every $3 the stock went up, you'd make $300 if you owned 100 stock. For every $5 the stock went down, you'd lose $500 if you owned 100 shares of stock. Well, having a synthetic position, you are going to see the exact same graph. Okay, same with a short stock position. You could have sold 100 shares of Apple. If the stock goes up, you're going to lose. Stock goes down, you're going to win. You can have that same replicated or synthetic position that would look exactly the same. Okay, and then we can go through all of these as well, but your graphs, your P&L potential is going to be exactly the same. Synthetic long call, synthetic short call, synthetic long put, synthetic short put. Let's look at this example right here. Earlier in the day in the OpVol room, I asked everybody, I said, give me a stock that you want to look at during Market Minds today. Uber was the first one that somebody mentioned. So I grabbed a screenshot here, which hopefully everybody can see. Okay, and here are all the variables. The stock was trading 80.61. Okay, and at that time, we're just going to use the at the money option. You can use whatever strike you want, so long as you use both the same strike for the call and the put. Doesn't just have to be at the money. We're going to use closest to at the money here. It will probably be easiest for the example. Okay, so we're going to look at the 80s. The 80 call priced at 177 with a 59 delta. Okay, does everybody see that? Does everybody understand that? Okay, now at the same exact time, because this was a snapshot in real time here, the 80 put, $4, 41 delta, or because it's a put, negative 41 delta. Okay, everybody's got it? Excuse me. Okay, excellent. So if we go back to these equations here, where long stock equals long call short put, blah, 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 we can plug these numbers in here from a delta standpoint and see what we get. So we know if you owned 100 shares of Uber, your delta would be 100, right? Stock is 1-to-1, 100 delta. Well, if we replicated that position by owning the 80 call and selling the 80 put, we've got a positive 59 delta owning the call. We have a positive 41 delta by selling the put. Remember, the put is a negative delta option, but if we sell it, a negative negative is a positive. That gets us to 100 deltas. So I can buy the stock, 100 deltas. I can buy, call, sell, put, 100 deltas. Does everybody understand that? Okay, now just by, again, rearranging the equation algebraically, now let's look at if we wanted to own just that 80 strike call. Well, if we had bought just the 80 strike call, that would be a 59 delta. Okay, a synthetic position for that, or a position that will act the exact same way, would be owning stock and owning that 80 put. 100 delta minus 41 deltas gets us to the same 59 delta. And then if we wanted to replicate synthetically owning the 80 strike put, which is a negative 41 delta, well, if we owned the 80 call and sold stock, that gets us to the negative 41 delta. Hi, Eric. Not only does this all prove out mathematically using deltas, all the other Greeks remain constant. Okay, your vega position is the exact same. Your gamma position is the exact same. Your theta position is the exact same. Okay, does everybody understand just the math here? And that's all I want you to take out of this is the math from a position standpoint, from a delta standpoint, proves this out. Okay, now why would we do this? And someone I saw something in the chat just a minute or so ago, less upfront money. Why would we do this? The biggest reason would be lower capital requirements. A synthetic long stock position, which is long call, short put, okay, costs you a lot less than purchasing 100 shares of stock. Much less capital outlay. Okay, and once you have the option position on, as we know, options give you options, you're typically able to hedge or work that position much easier than just having a stock position. Okay, but capital efficiencies is really one of the biggest reasons to do this. Before we go any further, yes, I told you we were going to get back to Lou Yesterday, she became 3 months old. Yesterday was her 3-month birthday. There she is. She is one happy baby. There is no question about it. Yeah, 3 months already. Doesn't it just seem incredible? Oh, she has a Bears jersey. No, we're gonna wait for the playoffs. We are definitely gonna wait for the playoffs. All right, let's get back to our convo here. Okay, so we talked about that capital, lower capital requirements, better efficiency there. Um, you have so much more adaptability, if you will. Okay, synthetic options rather than owning a stock or even being short a stock allows you to modify your positions so much easier than just trading the stock outright. And the big thing here is not only from the delta, okay, did the math prove out, but it's also put call parity, which we're going to go back to in our Uber example right here. So here was the example. Okay. How much premium, how much premium extrinsic value is in this 80 strike call option? Anybody? It's not 61 cents, guys. The intrinsic value, would be 61 cents. So what does that make the extrinsic value? If the intrinsic value is 61 cents, there you go, Bushman, exactly right. And the options trading $1.77, that means the premium, or what's left, the extrinsic value, is $1.16. Okay? Does everybody follow that? Does everybody see that there is $1.16 of extrinsic value here? Great. Now, how much intrinsic value is there in the 80 put? How much intrinsic value in the 80 put? Good, Bill, Dave, perfect. Zero, right? It's not worth anything. Really isn't worth anything. So then the entire cost, the 104, is the extrinsic value. Now you're going to look at that and say, well, put call premium, there has to be the same amount of extrinsic value in a put as there is a call. And that is 100% correct. Well, why is there a difference of 12 cents here? It would seem like the put would be much less expensive than the call here. I mean, that's what kind of common sense math would tell me. Anybody questioning that? What, remember something I said earlier, maybe it slipped by when we were talking about the Greeks. So the delta lines up, gamma lines up, vega lines up, theta lines up. What's another Greek? We don't talk about it a lot. What's another Greek that does play into option pricing? Hi. Rho, David, you say rho, and that is correct. What is rho? Rho is interest rate sensitivity. Okay. Which means based on where interest rates are right now and what the cost to carry of money is over the next 2 weeks, because we're using January 2nd expiration, there's about a 12-cent difference due to rho. The further you go out, the further you go out in time, the bigger difference there's going to be. The closer to expiration, that put call parity is almost going to be exactly in line. The only other exception to when we would see that put call parity maybe being out of whack is what? We've talked about this. In fact, there's actually something coming up tomorrow here. Be done in 2. There's actually something coming up tomorrow in STX. What is the other thing that can affect put call parity? No, not earnings. Not earnings. Because earnings, if there's volatility that's priced in, it's going to be the same amount on the call as it is on the put. Yes, it is a dividend. It is a dividend. Tomorrow, STX is paying a 74-cent dividend. If we look at right here, the at the money's expiring this week in STX, with the stock trading just around 280. Okay, we're seeing the put priced much more expensively than the call. That is because there is a dividend priced in. All right, everybody. Again, thank you, thank you, thank you. Markets close at noon, noon Central Time tomorrow. So we will not be doing Market Minds tomorrow. We are all off to celebrate Christmas on Thursday. The markets are open a full day on Friday. We'll not be doing Market Minds on Friday. Here is our wheel for the day. Let's give it a whirl. And are we going to get Bushman, Dave Edwards, or Dave Schubert? It looks like Dave Edwards. We have a winner. Dave, you're very welcome, Bill. Dave Edwards, are you still in the house? I know you were earlier, just a minute or two ago, because you responded dividends. Sure, you're still here. And there he is. Nice, nice, nice. All right, everybody. Well, again, from the bottom of my heart, from the Prosper family, from my family, we wish all of you a wonderful, wonderful holiday season. Hopefully, that doesn't offend anybody, whether you celebrated Hanukkah, whether you celebrate Christmas, whatever it might be, Kwanzaa, I don't care, whatever it is. I hope everybody has an amazing, amazing holiday season, and we will catch you next week.